All right, we'll get going in just a few minutes. Make sure that we give everybody time to hop on. So hang tight for a few more minutes. All right, everyone. I think we'll get started here, diving in on the American Rescue Plan Act of 2021. I know you guys have all been waiting with bated breath. So without any further ado, we will jump in. Maybe. There we go. A little bit about our firm. I think everybody on this webinar probably knows about us. So we'll leave this up for a minute and move on. Quick overview of what we're going to run down. Really starts off with how this bill applies to individuals, starting with what you need to know for filing your 2020 return. Moving on into some of the things that are going to affect the businesses out there, and a quick recap on a couple of the things we've already covered because they are so important to those businesses out there that are trying to get some help. So we'll start off with everybody's favorite topic, which is the economic impact payment. So this time, the payments are $1,400 per person. They now apply to everybody, including dependents over 17, which is new. Previously, it was dependents 17 and under, they qualified only. These payments should start going out via direct deposit tomorrow. That's March 18th. What is new on these is the hard phase out limits. Before they phased out at 5% of the amount that your gross income exceeded these limits. Now the phase out for single starts at 75,000 of adjusted gross income and is fully phased out at 80,000 of adjusted gross income. So it's a really tight phase out window, where before there was no hard cap. So it's entirely possible that you got one of these payments before and you wouldn't get one now because of the new phase out limits. So this round of economic impact payments is a 2021 advance tax credit. If you'll recall, the last ones were 2020 advances. So if you haven't gotten your last economic impact payment from the CARES Act and the Consolidated Appropriations Act, one in the spring of 2020 and one right at the beginning of 2021, and you qualify based on your adjusted gross income, you can claim those as a refundable credit on your 2020 tax filing. So one more thing to keep in mind, these $1,400 per person credits, if you don't get them now, you will claim as a refundable credit when you file your 2021 taxes next spring. So a couple changes that are going to potentially affect your 2020 tax filing. The first one is taxability of unemployment compensation. So if your adjusted gross income for 2020 is under $150,000 with no phase out limit, so you either qualify or you don't, you can exclude $10,200 of unemployment income. For a joint return, each taxpayer can exclude $10,200 of income. But if one taxpayer got $20,000 of income and one got $5,000, it's not $20,400 total. One taxpayer is going to get to exclude $10,200, and the other one is going to get to exclude $5,000. So kind of quirky the way that works. It's actually $10,200 per person, not $20,400 per joint return. The IRS just gave us some guidance on doing this last night, actually, and they say that on Schedule 1, Line 8, if you have an unemployment exclusion, you're going to enter the actual taxable amount, and you're going to write UCE next to that line. And then if you've already filed your 2020 tax return, but you've included all of the unemployment income in taxable income, they have specifically said not to file an amended return at this point until they can get some more procedures in place on how to process those a little bit more quickly. So if you've already picked up all of your unemployment income as taxable income, sit tight. Don't try to file an amended return yet, because it's probably going to cause you more grief than do good, because they are really slow at processing those amended returns. So fingers crossed they'll have some sort of expedited process in place shortly to make those go through a little more quickly. The other thing that's affecting 2020 tax filing is the premium tax credit. This is for those folks who purchased their health insurance through the exchange and claimed an advance credit against the premiums. If you took too much credit in 2020, when you file your return for 2020, you don't have to pick that up as taxable as tax. So that is a huge benefit to those folks who otherwise would have potentially some large tax bills from those premium tax credits that they have to repay. This one, we haven't gotten guidance on the IRS on how to report. So if you qualify for the exclusion of the repayment of the premium tax credit, sit tight and wait until we get some guidance from the IRS on how exactly to account for that. So 2021 only for now, we have an expanded child tax credit. So for children under the age of 6, it's going to be $3,600. For children up to the age of 18, it's $3,000. So we've added an additional year of child tax credit, because if you'll recall, those stopped at age 17 before, and those credit amounts for both children under 6 and under 17 were $2,000 before. So we've expanded the dollar amount of the credit and expanded the children that qualify. And the other thing that they've done is, starting in July of this year, you can claim an advance refund on your child tax credit for 2021. Details on exactly how that's going to work are scarce, as the IRS is still trying to figure out exactly how to do it. They've said that you can opt out of taking the advance credit, which if you are potentially going to be phased out, you might want to do, because your withholding that you're claiming on your wages probably already has some sort of child tax credit accounted for there. So if you're a wage earner claiming the child tax credit and you don't have a large refund for 2020, I would encourage you to think twice about taking an advance on that credit for 2021, or you may have a surprise when you go to file your 2021 taxes and you already advanced something that was accounted for and maybe reduced withholding on your wages. So something to consider before you take that advance credit for 2021. And then finally, they've made the child tax credit fully refundable. Before it was refundable up to $1,400 if you didn't have enough tax to offset with the credit. So child tax credits dramatically expanded for 2021. Advances are available on that, and the amount has gone up. The expanded credit amount starts to phase out when your income is over your adjusted gross income is over these limits. So, and then if your adjusted gross income is over 400,000, then the other $2,000 of child tax credit also starts to be phased out. But only that expanded 1,600 or 1,000 additional credit starts to phase out at the lower AGI amounts, and the other phase out starts at 400,000, which is consistent with prior tax rules. The other thing that is dramatically expanded related to children is a child independent care credit. So for 2021, the credit is up to 50% of qualified expenses. The maximum credit is $4,000 for one child or $8,000 if you have more than one. And this credit starts to phase out completely again at adjusted income over 400,000. If your adjusted gross income is over 125,000, that 50% credit starts to phase down to 20%, but that starts at 125,000. For 2020, the credit amount was a maximum of 35%, and the phase out reduction from 35 to 20% started at $15,000 of adjusted gross income. So the credit is going to be quite a bit more, and the maximum credit last year, or the maximum qualified expenses were $3,000. So the credit's going to be quite a bit more in 2021. So if you're paying for child or dependent care expenses, take note of this. You're going to see a big increase in your tax credits potentially. They've also got an allowance for some rental and housing assistance. These programs are going to be administered by the states, so the actual specifics of how these are going to work are still a little bit up in the air, but there's assistance for renters and for homeowners to pay for rent, utilities, and housing costs. So if you are a renter or a homeowner that's struggling to pay your rent or your mortgage payment, help is coming. These programs are going to be administered by the state. There's already a rental assistance program that the December tax bill put in place. If you're a landlord and your renters are having trouble paying the rent, you can apply for them and help them out and get your rent paid. So that's administered also by the state. So that program's already in place. This provided some more money on to keep that thing up and running. A few other individual provisions here that we've got. The $300 per week unemployment benefit is extended through Labor Day. The premium tax credit is expanded for 2021 and 22. So if you had applied for that before and maybe didn't qualify, take another look at getting that insurance through the exchange and claiming that premium tax credit. The excess business loss limitation was extended 1 year. It was supposed to phase out. It was supposed to end in 2025, but they tacked on another year through 26 to help pay for some of these provisions. Disaster-related funeral costs are covered. They didn't really say exactly what those were and how much would be covered, but they did say that there's going to be some help for those. Presumably that's COVID-19 deaths. And then the earned income credit is dramatically expanded starting in 2021. So this COBRA continuation coverage affects both individuals and businesses. So employees who qualify for COBRA coverage can have their premiums paid by employers for April through September of 2021. The employers can turn around and receive a credit for the premiums paid. And then the other part of this is if your COBRA coverage period extends anytime through this April through September period, you can reapply if you hadn't taken it before, but you would be eligible now. So if you have any part of your COBRA period falling in this April through September, you can elect. You get another shot at electing into that. And then employers have to send out new COBRA notices by May 31st, 2021. So if you're an employer who has former employees who may be eligible for COBRA, make sure to get those notices sent out by May 31st of this year. So the child care stabilization grants are for qualified state licensed child care providers. They define qualified providers as open and available to provide child care or closed down because of basically COVID-19 related reasons, whether that's public health or financial hardship or any other reason really. These aren't super well defined exactly how these are going to work. Again, it's going to be administered via the state. But these grant amounts are going to be based on current operating expenses and are allowed to be used for personnel costs, rent, personal protective equipment, purchase or update of supplies and equipment, goods and services necessary to maintain and resume childcare, and mental health supports for children and employees. So if you are a state licensed childcare provider, take note that there is a little under 24 billion allocated to help you either open back up or stay open and provide childcare. The restaurant revitalization grants are going to be administered by the SBA, the same folks who brought us the Paycheck Protection Program. These eligible entities, there's a really long list, but really it's any place where public or patrons assemble for the primary purpose of being served food or drink. The list of places that don't qualify were shorter than those that do, so that's what I've got here for you. You don't qualify if you're a state or local business operated entity. If you have more than 20 locations, if you have a received or have a pending application for a shuttered venue operator grant, or if you're a publicly traded company. These grants are up to $10 million per entity or $5 million per location. And the grant is calculated by subtracting your 2020 revenue from your 2019 revenue, and then reducing by any PPP loans that you've received. So this is going to be potentially a huge benefit to some of those restaurants out there that are struggling. And you have between February 15th, 2020 and December 31st, 2021 to spend these on qualified expenses, payroll costs, mortgage payments, both principal and interest, rent, utilities, maintenance, supplies, food and beverage costs, covered supplier costs, operational expenses, which is probably going to be the same as the PPP, which is actually computing expenses, and then paid sick leave. So if you're a restaurant and you had a reduction in revenue between 2019 and 20, be aware that this is coming. I think that I read that they estimated the need for these grants was about 125 billion, and there's a little under 25 billion allocated to this. So it is probably going to go pretty quickly. So if you are a restaurant or know somebody who operates a restaurant, keep an eye out for this and apply as soon as possible. Of course, It's not open yet, but it is hopefully coming soon through the SBA. So we have an expanded employee retention credit. A few things that they've added. They have now allowed the employee retention credit for all 4 quarters of 2021. They expanded to allow recovery startup businesses, which are those businesses that began carrying on a trader business after February 15th, 2020. So if you started your business after February 15th, 2020, your average annual gross receipts are under $1 million, and you're otherwise not eligible for the employee retention credit, you can take it up to $50,000 per quarter. So that's going to be a huge benefit to those new businesses that started up in 2020 that weren't otherwise eligible because they didn't have a qualified reduction in gross revenue. The expanded eligibility for severely distressed employers is those employers whose gross receipts were reduced by over 90%, and those employers have all wages qualifying for the credit, even if they exceeded 500 employees. So if you had a reduction of over 90% of your gross revenues, you're going to qualify for the retention credit, even if you otherwise wouldn't because you had too many employees. So if you recall, what qualifies for the employee retention credit, we'll have a little bit of review here because this is such a huge credit for anybody that does qualify. So the Consolidated Appropriations Act that was passed in December expanded the retention credit to allow employers who also took a PPP loan to qualify for this retention credit and to be able to amend their 2020 941s to go back and claim this credit because they didn't think they weren't eligible at one point because they had taken a PPP loan and the rules changed in December after they'd already filed their 941s for second and third quarters. So for 2020, if you had a reduction in gross revenues of 50% in any quarter compared to the same quarter in 2019, you would qualify for that quarter and the next quarter, and you got a credit for 50% of wages up to $10,000 per employee per year for 2020. So you're looking at a credit of up to $5,000 per employee for 2020, depending on the wages paid. You also can qualify if you were fully or partially suspended due to orders from a government related to COVID-19. So our shutdown from late March to early June would qualify for a lot of employers out there that maybe didn't have a reduction in gross revenues, but we're dealing with the government shutdown, and so they would qualify for that period at least. For 2021, the credit was expanded to be 70% of wages, up to $10,000 per employee per quarter, and the revenue reduction requirement was decreased from a 50% reduction in revenue in any quarter to a 20% reduction in revenue in any quarter. So more credit, up to $7,000 per employee per quarter in 2021. So if you had a reduction in your quarter 1 2021 revenue compared to quarter 1 2019 revenue, you would qualify for this credit up to 70% of wages that you paid to your employees, up to $10,000 per employee. The only wages that don't qualify for this are for relatives of greater than 50% owners, and then also those wages that qualify for PPP forgiveness. So if you have a PPP loan and you are wanting to claim the employee retention credit, I would strongly encourage you to calculate your employee retention credit and figure out how best to allocate the wages between the PPP and the retention credit before submitting for PPP forgiveness. But this employee retention credit is super important for anybody that had a revenue reduction of greater than 20% in 2021, 50% in 2020, or started carrying on a trader business after February 15th, 2020. So we expanded the sick and paid family medical leave credits through September 30th of 2021. The limit on the family leave increased to $12,000. The paid leave credit is now allowed due to COVID-19 vaccinations, and the limit on the overall days taken resets after March 31st, 2021. So these were those first credits that came under the Families First Corona Relief Act back in early March of last year. So these are now expanded through September 30, 2021. The targeted EIDL advance. So this first came about under the December 2020 Consolidated Appropriations Act. They put $10 billion more funding towards those folks that qualify under that. And then another $5 billion in funding for additional EIDL advance grants to businesses who have suffered an economic loss of more than 50%, employ 10 or less employees. And those grants are up to $5,000. SBA has said that you don't have to apply for these, that they will send these out automatically. I haven't heard of any of our clients that have gotten these automatically, but if you qualify, keep an eye out for them and keep an eye on SBA's website in case there is something that you may need to do to claim these credits. But basically, this was that first $1,000 per employee that you got up to $10,000. The December 2020 bill said if you were in the right area and you got less than 10,000, they would give you the difference between 10,000 and what you got back in the spring. And this additional $5 billion is going to take those folks who have 10 employees or less, suffered an economic loss greater than 50%, make sure that they all got at least $5,000 in targeted EIDL advances. Again, on these, nothing that you have to do in order to qualify, but keep an eye out there for them. And then a little bit of expansion on the Paycheck Protection Program. The Rescue Act added another $7.25 billion in funding. They allow shuttered venue operator grants recipients to apply for PPP loans, as long as they do so after December 27th, which should be pretty easy since they weren't allowed to before then. The PPP was expanded for sole proprietors. This was, I believe, the week before last. They allow sole proprietors to base their loan amount based on their gross income, not their net income. And then a reminder that those PPP applications, at least for now, must be submitted by 3/31. So about 2 weeks to go on those. The banks are probably going to start cutting those off pretty quickly so that they can make sure to have time to get those processed. The banks and numerous other people are lobbying SBA to extend the application period for another month and give them another month to process those. So, so far as of today, the application period runs through March 31st, but it is possible that it will be extended for at least another month. And with that, that's all we've got on the latest bill. I will take a look at the questions that you guys have put into the chat here, and I will address those, and we'll post those to our website shortly after the end of the webinar. We'll keep this up for a little bit. If you do have any more questions, post them there to the Q&A section so that we can get those answered for you. Thanks everybody for joining us, and we will keep pushing information out as we get more clarification from the folks back in DC.